Hello everyone, welcome to Amillex Global. Today, we break down how NFP influences the economy, interest rates, and major market assets by decoding its three core indicators. Non-farm payrolls, or NFP, is one of the most important economic releases in global markets. But to truly understand its impact, you can't focus on just one number. You need to read the full picture. First, average hourly earnings month on month. This measures how much wages have changed compared to the previous month. Why does this matter? Wages are an early signal of inflation. When incomes rise, consumers spend more. More spending can push prices higher. If wage growth accelerates too quickly, it raises inflation risks. That's when the Federal Reserve may step in, keeping rates high or even raising them to cool the economy. This single data point often shapes the market's inflation expectations. Next, non-farm employment change. This is the headline number everyone watches. It shows how many jobs were added or lost last month, excluding agriculture. Because the U.S. economy is driven by consumption, job growth means more income, more spending, and stronger economic momentum. But it's also one of the most volatile releases. At the moment NFP hits the screen, the U.S. dollar, gold, equities, and indices can all move sharply, sometimes within seconds. Finally, the unemployment rate. This measures the percentage of people who are able and willing to work, but couldn't find a job. It's important, but it often reacts more slowly than employment growth. That's because it comes from household surveys, not company data. Sometimes companies hire aggressively, pushing non-farm higher. Yet unemployment still rises, because more people enter the labor force looking for jobs. This tells a deeper story about labor supply and real economic pressure. So why must traders analyze all three indicators together? Non-farm employment shows whether companies are hiring. The unemployment rate shows how much idle labor still exists. And wage growth shows whether consumers actually have stronger purchasing power. Strong job growth without rising wages may signal weak consumption. Surging wages without productivity gains may fuel inflation. Only when all three align can we judge whether growth is real or just a false boom. From data to markets, NFP mainly moves prices through interest rate expectations. If the data is stronger than expected, the Fed is more likely to maintain or raise rates. Capital flows into the US dollar, pushing the DXY higher, while gold and non-USD assets face pressure. If the data disappoints, rate cut expectations grow, the dollar weakens, and funds rotate into gold and alternative currencies. In short, don't treat non-farm like a casino. Risk control is your real edge.